Hey traders, welcome back. So we're into part 2 of the pivot points video mini series, if you like, and now I want to talk about some strategies and setups of how we can use them. In the previous video, if you haven't looked at it, go and check it out. We quickly looked at what the formula was to calculate these pivots. We looked at why they were weighted as they are, what it meant for us the next day, all that kind of stuff. So we have a wide range in the prior day. Our pivot points and our R1 and R2, S1, S2 are going to be wide. We have a narrow range the prior day, they're going to be tight as well. So let's have a look. So the idea generally is, and I'm going to exclude this, what I've got up here now is the S&P 500 ETF, otherwise known as SPY. The reason I have used that is because personally I think the close, i.e. the cash close, whether that's the DAX cash close, the FTSE cash close, S&P, Dow, whatever it may be, if it's an index and it's related to a basket of stocks, the close for me, or the most useful close for me, is that cash close. So that is why I have included, or why I've used the S&P 500 ETF for this, as opposed to the classical S&P CFD or Dow CFD. I'm not saying that's right, but that's just the way that I like to look at stuff. Okay, so the theory is that price will be contained between S2 and R2, sorry, and S2 most of the time. It will trade around the pivot, and then once it breaks through the pivot, the theory is that that then has control. The bars are in control, and they will push it either to S1 or S2 to the downside, or R1, R2 to the upside, depending on obviously which side it has broken. But if you can just eyeball this, and you can just see how often, you know, these pivots come into play. Let's get the pen out again here. You know, this R1 just kept price really well contained here. On the next day as well, we broke through it. We tagged, you know, the pivot point. We actually gapped up. Obviously, that's affecting the pivot. We gapped up. We came down, tested the pivot, and then R1 kind of held price, you know, reasonably within range. Like I say, with any of these things, this is not perfect, and obviously nothing beats, in my opinion, drawing an actual support or resistance line based on what has happened, as opposed to theorizing what could happen. But nevertheless, it gives you a real good clue as to what's going on. So, trading strategies. The theory behind the trading strategies are, let's give ourselves a little bit of leeway, and let's put the 24-hour FTSE up just to see exactly what it's showing us. Okay, so we've got the 24-hour FTSE here, and you can see how we're ping-ponging around between R1, S1, S2, and things like that. So it's keeping things in its own boundaries. Let's have a look at Euro US dollar, and we'll talk about some trading strategies. So hourly. Let's go for an hourly. Let's keep it a bit cleaner. So the theory behind it is that as you tag a key level like S2 or S1, you will fade that move. So in other words, if you're above the pivot and you're heading towards R1, you won't go short until you tag R1. So the idea is, you're not, when it's above the pivot but below R1, the balls are in control, and you're really looking to get long and stay long, or push for the long until it hits R1. Of course, never going to happen all the time, but that is the general premise behind these things. So, I mean, look at that monster there. Obviously, that was a news-driven thing, which completely blows the pivots out the window. But if you're working off, should we go back to 15 minutes so we can see things a little bit clearer? I like my shorter time frames. I know some of you guys out there don't like the shorter stuff, but I have to say I do like the shorter time frames. So the theory is, let's go back to a normal day. Let's get rid of the skewed kind of range expansion days. If we talk about a normal day in inverted commas, if there is such a thing, theory is we're buying at the pivot. If we open above it, we'll come down, we'll touch the pivot, we're looking to buy at the pivot. So we'd be buying around here. Now, obviously, you may be getting stopped out depending on what your stop is, but the theory is you're buying there and you're looking for the move up to R1. You're looking to sell at R1 unless we close above it or do some work above it, then you're waiting for it to tag R2. Now, that's the theory behind it, and I keep using the word theory because it is really a theory. The way that I think it's really valuable is using it as a target point. So use your own strategies and setups to get into the trade, and say, hey, you know what, I'm buying a pullback here, or I'm buying some support here, or whatever. But use the probabilities, which I'll show you in a second, to really give you that confidence to hold the trade. So let's say you've bought down here, okay, I know we've got to be careful we don't cherry pick, and you know that I'm very cautious about cherry picking stuff because it doesn't do us any good as traders. We're all looking to improve here, not trying to prove a thesis or anything like that. So let's say we'd bought a kind of double bottom here, and that's just put it right in front of everything, isn't it? Yeah, so let's say we bought a double bottom here, whatever it is. Okay, the point is we've gone long for whatever reason around this level, and we've started to see a little bit of a pick back up, or even probably more likely we've bought a break of this kind of low here and looking for a push back up. Now, the interesting thing is if we're long and we know that the chances are we tag R1 or S1 at least 80% of the time, and those are statistics, and I'm going to give credit in a minute to the person that I got this data from. But 80% of the time we are going to tag R1 or S1. So the theory being, if we can get on the end of a trade, in other words, we've bought for whatever reason, whether it's the break of this high, whether it's a double bottom, it doesn't matter, that's not the point. We're long, we know that if the buyers continue to stay in control, this thing is likely to test that R1, or if we're flipping it on its head and we're going short, it's likely to test S1. So it really enables us to frame the trade in a far better manner. We can use our whatever level stop we've got, and we can say, hey, we are going to tag one or the other. If I think I've got an edge here by saying this is our entry point for whatever reason, I'm going to put my stop here if I'm wrong, because I could be wrong and I could be going to S1. But if I think I've seen the change in supply demand and I get on board it, I will try and hold it for the full move. So let me bring up now where I have this data from, because this guy is a good guy. Here we are. This is from Brett Steenbarger's blog, Trader Feed. I would thoroughly recommend it. And if I can bring it in, I don't know if I've got it. There we go. traderfeed.blogspot.co.uk. This guy, Brett Steenbarger, has written a load of books. Not going to go into too much depth now, but this is a really good blog. Anyway, the point is, a few years ago, he did a study here, and he basically, a long time ago now, 10 years ago. So there may be a more frequent study, but the point is these things do repeat themselves even as market conditions change. We haven't really changed that much. So we've probably got more weight into the upside, obviously, with the bull market. But in theory, this is what happened. So if we go back, he went back 2004. So he took 963 trading days, and he used the S&P 500 ETF as well for this study. He's found out that you hit S1 or R1 over 80% of the time. Okay, so that's really interesting. Again, he splits it up into the fact that you can hit, it was about 50-50 split, and I guess it can depend if you're in a bull market or bear market, and that you only hit both 15% of the time. But this is the one I'm interested in, 80% of the time. So how can we use that, guys? How can we use the fact that we're going to hit one of those 80% of the time? We don't know which one's going to hit. That's a coin toss. But if we use that statistic on its own and say, hey, 80% of the time we're going to hit one of them, if we feel we've got the momentum or the turning point, then we can use that probability as our target. So back in that example, we think for whatever reason we've gone long, and again, that's kind of separate from the argument here. You take the setup, you take the strategy, your target should be R1, or it should be, if you're taking a short on a breakdown lower here, S1. Because the probability of you hitting that within the day is 80%. So if you believe you've got the momentum right and the direction right, then you're probably going to likely hit that target. So that's the way to do it. That's the way I think is the best way of framing these kind of pivot points. There are other ways of using them. There are other kind of things where you can generally say if it's broken R2 and it's with momentum, then if I can scroll through, whoops, I've got my drawing pen out still. Yeah, once you've broken R2 and you're holding above it, then you kind of look for a move, a real explosive move, and it's a real kind of reprice scenario, which is what we got here. And obviously the next day, you've got to take it with a pinch of salt. I mean, I'd say that's more luck than anything, the fact that it stopped at that pivot point. Some people are probably going to say, oh, no, it's a pivot point. I don't really buy that, because yesterday was such a wide kind of range, so you've got to be careful the next day. But the fundamental thing is you're framing the day's trade. You're saying, hey, this is the kind of high and low. We're likely to tag one of these, 80% chance of tagging one of these, slim chance of tagging both and being a whipsaw day. We may then extend, I have to look at some odds and statistics for the R2 and S2 stats, but giving yourself that framework means that at least you're trying to find something that's with the direction of the momentum. Supply demands in one direction, it keeps you on one side, or it keeps you out the trade and stops you making losing trades by chasing things, or generally getting carried away, or not being patient, or waiting for that key level to touch. I mean, listen, if you're close enough to R1, if your plan was here to go short at some point and you're close to R1, if you know 80% of the time it's going to tag it, then you may as well just back off and wait for the tag and then hit the short if you still feel the short's valid for whatever reason, because the likelihood is it will tag it, isn't it? Because you're close enough, you've got the 80% behind you. Wait, back off, give yourself that little bit of extra edge, wait for it to just go through it, and then take your short if that's part of your trading thesis. So anyway guys, that's pivot points for you. Check them out, available on most of your charting packages. If not, very simple to code up if you're using something like MT4 or TradeStation or the like, if they're not already in your software. And I hope you enjoyed this video, guys. A little bit of a longer one than normal, but I find this topic quite interesting. If you've got any other links, by the way, to studies of pivot points, would love to hear about them and read about them, so share them in the comments below. Any comments as well of how you use pivot points or don't use pivot points, stick them in the comments below. Give it a thumbs up if you like this video, and don't forget to subscribe for more from me and other traders on this channel. Take care guys, bye bye.